Good afternoon and welcome, ladies and gentlemen, to the Wednesday Lunchtime Drive Through on Wednesday, September the 15th, 2021. I'm your host, Damon King, certified financial planner professional and wealth management specialist with ChappelWood Financial Services. I'm also the lead instructor for ChappelWood University, which is the educational branch of ChappelWood Financial. If you're new to the Wednesday Lunchtime Drive Through, welcome. You're in for a treat. These quick little bite-sized 30-minute webinars have become very, very popular. In fact, they're probably the most popular educational event that we host, even more so than our flagship 4-hour course, Rock Your Retirement. People just don't have as much time these days, and so 30 minutes is doable for pretty much everybody. Today, I am revisiting a topic that I've shared in the past, but I needed to revisit it because there have been some changes. There have been some updates. So we have talked about some of the proposed tax legislation that is being pushed by not just President Biden, but many of the Democrats in Congress. And so, as I always say, I do not have a political agenda when it comes to these kinds of presentations. I really don't. I have my own political beliefs, but when it comes to teaching and educating you, I throw that out the door just to give you the cold, hard facts. Okay, this is just what is being proposed. So nothing that I'm going to talk about today is said through the lens of all those stupid people. Okay, this is just what's going on in Congress right now. As always, if you have a question or a comment, you may leave your question down in the Q&A box or the chat box in your toolbar, probably at the bottom of your screen. And I'll do my best to answer any questions that you have today. So we want to talk about navigating the proposed tax legislation. So what is the latest news? On September 13th, that was just 2 days ago, on Monday, the House Ways and Means Committee released their proposal titled Responsibly Funding Our Priorities. What they want to do with this potential bill is to raise $2.9 trillion in tax revenue that would pay for many of President Biden's proposed initiatives. And these initiatives range from paying for the infrastructure bill that was just passed. A lot of it is related to rescuing Social Security. There are a lot of concerns about Social Security, and rightly so. If nothing is done about Social Security, we are looking at a shortfall between taxes collected and benefits paid out starting somewhere around the year 2034. And so this new tax bill or these new tax changes would raise close to $3 trillion in revenue over time, not all in 1 year, but over time, to try to counteract Social Security's issues, as well as some other things that they want to pay for. So while this proposal is nowhere near close to becoming law, it's the best glimpse that we have so far into what we might actually expect to get passed at some point, maybe later this year. I'm thinking probably it's more likely that we're going to see it the beginning of 2022, because there's still a lot of stuff that has yet to be worked out. So let's dive into this a little bit. What's in the proposal? Well, there is a series of sweeping changes to the tax code targeting a variety of tax-paying entities, but the entities that most of these proposals are targeting are individuals, so you and me, retirement accounts, also you and me, estates, you and me, business owners, you and me, right? So this impacts literally everybody in the country. Now, it does not necessarily impact everybody, all taxpayers equally. In fact, there are certain taxpayers that these proposals are targeting directly. And we're going to get into that in just a second. Some of these proposals wouldn't just change the tax code, they would drastically alter it and actually take away some of the key planning strategies that we as financial advisors like to use, that we recommend to you, millionaires and aspiring millionaires who are our clients, our listeners, our followers. So listen up, because these proposals could be coming to a tax return near you. All right. So let's talk about individuals. And some of these have a couple of multiple slides. So they're looking at, they want to take the 32 and 35% tax brackets and shrink them down. Basically, they want to shrink the amount of income that it takes for each one of these brackets. Right now, they're much wider. They want to shrink them down, meaning that it would take less income to jump up into the next higher tax bracket. So they want to see some compression in some of these higher tax brackets so that less income would actually put you into a higher income tax rate. They want to move the top tax rate, and this one we already knew. They want to move the top tax rate from 37% to 39.6%. Now, 39.6%, to give you context here, before the Tax Cuts and Jobs Act of 2017 was passed, the top income tax rate was 39.6%. It was lowered to 37%. If nothing changes, it's going back up. In fact, all of the tax rates that were lowered starting in 2018 are going back up starting in tax year 2026, including the top tax bracket, which is going back to 39.6%. The difference is that instead of waiting for 2026, the Biden administration wants this to take effect starting in tax year 2022, I think, or 2023. So they want it a few years earlier than what is currently set to have happen. Clearly, these two proposals are targeting top income earning households. All right, so they're, again, the higher tax brackets are going to impact people with more income. The top tax rate is going to impact you, certainly if you're making over $400,000 per year. So these are clearly aimed at top income earning households. But wait, there's more. They want to increase the long-term capital gains tax rate to 25% for people with income above $400,000. Now, currently, the top long-term capital gains rate is 20%. If you include on there the 3.8% net investment income tax, or the NIT tax, then for long-term capital gains, your top tax rate is 23.8%. They want to increase that 20% to 25% for people who earn above $400,000. But here's the interesting thing. The proposal that I had seen before, actually, President Biden wanted to increase the long-term capital gains rate basically to ordinary income tax for people at $400,000 income or higher. So he basically wanted to just charge ordinary income tax for capital gains. So this would actually be a net positive, at least from that standpoint, if the long-term rate only went from 20% to 25%. So that's kind of interesting. Another proposal: taxpayers with modified adjusted gross income above $5 million would pay an additional 3% surtax. So in addition to the income tax that they would pay anyway, they would pay an additional 3%. Here's an interesting one. If you're a cryptocurrency investor, and again, these are targeting people with high incomes, okay, 400,000 and above. Well, actually, no, this would apply to everybody. Cryptocurrency would be subject to the wash sale rules. What is a wash sale? A wash sale is when you sell a stock or an asset. Typically, you're selling it for a loss. Okay, you want to harvest a loss to try to offset your taxes. What a lot of people will do then is they sell the asset at a loss, harvest that loss to offset capital gains, and then in a very short amount of time, meaning less than 30 days, they turn right around again and buy that same asset now at a lower price, and they're hoping to benefit from appreciation. Well, Congress and the IRS see through this. And so if you sell an item, an asset at a loss, and then less than 30 days later, you turn around and buy back that exact same asset or one very similar to it, that is called a wash sale. And what that means is the sale that you had of the asset at a loss is not really considered a sale. They take the sale and the purchase, and that's considered one transaction. So what they're trying to prevent here is people, if you have these wild swings in Bitcoin, let's say, and if somebody wants to turn around and sell their Bitcoin at a significant loss to harvest a loss, but then turn right back around and buy back the Bitcoin at a lower price, if they do that in less than 30 days, that will be considered a wash sale, and they will not have the benefit of being able to use that loss to offset their capital gains. Does that make sense? So if you're going to avoid a wash sale, you have to sell the asset and you need to wait at least 30 days before you buy that asset back or one similar to it. Otherwise, the loss you will not be able to harvest or use. So obviously, these proposals are targeting investment activities of high income and high net worth households. Again, you are sensing the trend here, right? The theme here is tax the rich, attack the rich, attack the wealthy. All right. So again, I'm not making a political statement. I'm simply telling you this is what they're targeting. All right. There are political motivations behind it, clearly. But mine is not. I simply want to educate you and inform you of what is on the table for right now. Let's talk about retirement accounts. Major changes potentially coming to retirement accounts. Let's see, we've got a question here. Okay, Ralph asks a great question. And I really should have clarified this. Sometimes I don't because I just run out of room on the slide. Ralph asked the question, is the 400,000 single or filing jointly? That is filing singly. The amount of income for filing jointly is $450,000. Okay, so when I'm showing you 400,000, that's kind of the low end, but that's for a single filer. The income amount is going to be 450,000 in most cases if you file a joint tax return. So thank you, Ralph, for asking that question because it gave me a chance to clarify that. So thank you. Let's see, let's go into the retirement accounts. This proposal would eliminate all Roth conversions for people who are in the highest income tax bracket. So again, $400,000 if you are single, $450,000 if you file a joint. So essentially, you would not be allowed to convert your pre-tax traditional IRA money to after-tax, tax-free Roth IRAs if you're in that top tax bracket. Now, here's the crazy thing. It's not set to go into effect until December 31st, 2031. So you've got 10 years, okay? You would have 10 years to get that done. Effective on January 1st of 2022, however, so just next year, it would eliminate the conversion of after-tax amounts in tax-deferred accounts to a Roth IRA, effectively killing the backdoor Roth conversion strategy. So let me unpack what that means. If you earn too much income above 200, let's just call it $200,000, let's say. I don't remember what the exact number is, but it's around $200,000 for an individual, a little higher for a joint. If your income is too high, you are not allowed to make a contribution to a Roth IRA. So what do? Well, you can contribute to a traditional IRA, or you can just put your money into an after-tax brokerage account, but you cannot contribute new money to a Roth IRA if your income exceeds the limits. So what a lot of people do to try to get money inside of a Roth IRA is what's called a backdoor Roth conversion. So what they'll do is they'll set up an IRA, special IRA, to receive non-deductible contributions. So you set up a traditional IRA, but you make a contribution to it and you do not take the deduction. All right. Most people just assume, well, if you put money into a traditional IRA, it's automatically deductible. You would assume that because that's what most people do. It is possible to put money inside of a traditional IRA and not take the deduction. It is not a requirement that you take the deduction. If you do take it, well, then that money will be taxable when you pull it out later. But if you do not take the deduction up front, you essentially now have after-tax money inside of a tax-deferred account. Why would you do this? The point to a backdoor Roth conversion is you contribute non-deductible money to a traditional IRA because you can do that even if you have too much income. And then you immediately convert that non-deductible amount to a Roth because there's no limitation on Roth conversions. If you do that very quickly, and most people do it on the same day, when that money goes inside, the non-deductible portion goes inside the traditional IRA, you don't allow it any time to grow in value, and you immediately convert it over. That way, when you make the conversion, you are not paying any tax on the conversion because there's no appreciation. There's no growth to be taxed. So that's what a lot of people do. That's how a lot of wealthy people get money into a Roth IRA, because they can't contribute to it directly. But this law would eliminate the ability to convert non-deductible contributions to Roth, effectively killing the backdoor Roth conversion strategy. You wouldn't be able to do it. I don't really understand the point of this particular proposal. Because here's the deal. When you do a Roth conversion, what happens? You pay the tax on the converted amount, right? Roth conversions are a major source of tax revenue for the federal government every year. I mean, we've got clients all over the place that convert 25,000, 50,000, 30,000. You know, they generate a lot of tax revenue for the federal government. So I'm kind of curious, what is the purpose of this? Because if you are preventing these wealthy people who have a lot of money and are at a higher tax rate, if you're preventing them from converting to Roth, you're preventing people who would pay a higher portion of that conversion in tax, right? Thereby generating more money for the federal government. The only reason I can think of this is to prevent dynastic transfer of tax-free wealth to heirs. Okay, that's one reason why maybe they're doing this. It's like, okay, we'll sacrifice the short-term tax benefit or the tax revenue in exchange for not allowing families to pass on like $20 million of Roth money. Because when a Roth account is inherited by heirs, that money's tax-free, right? And so they want to prevent these dynastic, multi-generational transfers of wealth that are tax-free, I guess. I really don't know. So I'm kind of curious if this one's going to stay. But if you want to get your Roth conversions in, you might want to get it done now. Because who knows how much of this could be retroactive. That's the other aspect to all of this, is that there's a chance that if this were to pass, honestly, I don't think it's going to pass before the end of the year, but let's say that it passes in November. There's a chance that these provisions could be retroactive to November. So we'll see. Some more retirement account changes coming. Single taxpayers with more than 400,000 income and joint with more than 450. So there you go, Ralph. Apparently I spelled it out on this slide. So if you exceed those income amounts, whether you're single or joint, and you own IRAs with total balances above $10 million, you will no longer be able to make contributions to your IRA accounts. So essentially, you would be capped as a high income earning family. You would be capped at maintaining IRA balances of $10 million. Well, what if your account balance is higher, or the total of all of your IRAs is higher than $10 million? The government would require you to take required minimum distributions equal to 1/2 of the amount above the $10 million mark. So let's say you've got $12 million, all right? You got $12 million inside of IRAs total, all right? So that's $2 million above the threshold. They would require you potentially to take out 50% of that total for that year, which is $1 million. Yeah, you heard me right. They might require you to take out hundreds of thousands, maybe $1 million to equalize to get back to that, okay? Until the balance is equal to or less than $10 million. Again, with these proposals, they are clearly targeting high income, ultra high net worth households, and they're trying to prevent these families from deferring taxes on hundreds of millions of dollars, which right now you can. They're trying to prevent this so that they get the tax revenue sooner and it doesn't just get pushed off and passed on to other family members, other heirs, potentially at a lower tax rate. All right, moving on. Estates. So what are some of the changes coming to estate planning? They want to cut the gift and estate tax threshold, which is currently at $11.7 million per person. They want to cut that in half starting in 2022. So here's how this works. Your estate, we have what's called a unified gift and estate tax code. What that means is that the sum total of the gifts that you make above the annual exclusion amount, which is $15,000. So you can give any number of people a one-time annual gift of $15,000, and there's no gift tax. And it does not count against your lifetime exclusion amount. Anything above that amount that you give as a gift during life will count towards your 11.7 million total that you can pass on to your heirs throughout your life and then after your death. So they take together the gifts you give in life and the gifts you give after your death. If the sum total of those is lower than $11.7 million right now, your estate will not owe estate taxes. If it's above that, then you will owe whatever the estate tax rate is on that amount of money. So that means, and married couples can put theirs together. So let's say that you've got one spouse that passes away, and let's say it's the husband who passes away and the wife is still living. Well, if the husband still has $5 or $6 million left of his, and the wife still has her 11.7, you're talking about 16, 17, 20 million, a maximum of over $23 million that you could pass on and still avoid estate tax. Now, that is supposed to go back down to 5 million starting in 2025 anyway. Okay, so the 11.7 is going back to 5 million per person starting in 2025. The Biden administration wants to cut that in half starting next year. So that would mean that for people who pass away next year, if this bill passes, that now their estate tax threshold, everybody's, is instead of 11.7, it's 5.5, let's say. Okay. Now, that's somewhat concerning, but the one that concerned me more than anything was the potential of repealing the step up in basis rule, because that's one of the proposals that they've been making. Right now in this proposal, repealing the step up in basis is not on the table, which is great for all of us, because the step up in basis is a fantastic tool. I'm going to give you a perfect example. We've got some clients right now. They just inherited an account from their dad. We got 3 sisters. They inherited an account from their dad. Okay. Now their dad, it's full of mutual funds and stocks and things like that. Now their dad paid X amount for those assets, right? His cost basis was established many, many years ago. Well, those assets have appreciated significantly in value, to the point that if he were still alive and he sold them, or even if his estate sold them, there would be a really significant capital gains tax, right? However, when you inherit assets like that from someone, your cost basis is not what they paid for it. It's what the value of the asset was on the date of their death, which is significantly higher, right? That means that if you turn around and sell that asset, there's going to be a much smaller difference between what your cost basis is and the value, meaning your capital gains tax would be much lower. Could be nothing if you sell it for exactly what your cost basis was. If they had repealed that, that would have removed one of our best planning tools, because for these 3 sisters, their bank or their dad's bank was just going to liquidate all of these assets and then send them cash. Had they liquidated those assets while the account was still in the name of their dad's estate would have paid a significant capital gains tax. Instead, we directed the bank, don't sell the assets first, transfer the assets in thirds in kind to each of the 3 sisters. Then once they're there in their accounts, we will sell them at that time. That way, they get to take advantage of the step-up rule and significantly minimize the capital gains. Your run-of-the-mill advisor is not going to think about stuff like that. That's why you want to work with your advisor when you inherit money like this, because you could end up triggering inadvertently some significant capital gains taxes and reducing the amount of money that you would get. So you want to take advantage of the step-up rule. So I'm glad they're not going to get rid of that. I really hope that this stays. Another proposal it would dramatically increase the special use valuation for farm and family business real property. Right now, there is a rule that states, okay, if you own a family farm, your mom and dad own a farm, or they own farmland, or some other piece of property that's in a family business. When that person dies and they pass that asset on to you, there are two different ways that you can value that farmland. You can value it just as a farm, as though you were only going to use it as a farm, or you can value it at fair market value for any purpose. Well, obviously, if you value something and you can only use it as a farm and it only has one use, that makes the land a little less valuable, right? You don't have as much flexibility to use it for anything else, as opposed to if you inherited land that you could go sell to a developer who's going to build a huge housing complex. That has much more value on the open market, right? You can elect special use valuation for an estate, which reduces the value of that asset and thereby reduces the value of the taxable estate. Do you understand? Does that make sense to you? So if you have a family farm or a family business and the heirs want to continue the family farm as a functioning farm, or they want to continue the business, you can elect special use valuation to significantly reduce the value of the taxable estate. Well, this rule would expand that special use valuation. Now, I don't know how they're going to expand it. Are there going to be more items that you can use? Are they going to give you bigger credit? I don't know. But the estate tax threshold, like I said, is set to fall back to $5 million in 2025. And these proposals, or at least that top one there, would move up that schedule significantly by 3 years. Okay. Any questions on that? That one's kind of a complex thing to describe or explain. So hopefully I did a good job explaining that to you. If you have any questions, please let me know about that. The final one that we want to talk about here are business owners. So if you're a business owner, let's say you own a C corporation. Okay, so there are many different types of businesses. You can have just a sole proprietorship. You can have a partnership. You can set up an LLC. You can set up an S corporation. You can set up a C corporation. And each one of those entities has their advantages and disadvantages. The C corporation or corporate taxes right now are 21%. So a C corporation, an example of that would be Microsoft. Any of the big companies that you buy their stocks in the S&P 500 are corporations. Well, you can own a corporation too. You can incorporate your business, and your tax rate would be 21% right now. They want to increase that from 21% to 26.5%. That's actually a little lower than what it was being proposed originally, which was 28%. The corporate tax rate used to be 35%. It got lowered to 21%, and they were talking about splitting the difference and bringing it back to 28. Well, right now it looks like they're settling on 26.5%, but for businesses with more than $5 million in revenue. So this would really only impact fairly large companies. Okay, we're not really talking about small companies, but for smaller companies, for personal incomes above 500,000. So if you have so the top one is about the business's total revenue. But if you own a small company and your personal income, and let's say the company is an S corporation, your personal income is above $500,000, not the company's income, but your personal income. Those S corporation profits, in addition to whatever tax rate, there would be an additional, the 3.8% net investment income tax, or the NIT tax, would also apply. So that's another thing. They're looking at taxing small businesses a little bit more. And they would also limit the 20% pass-through deduction to $400,000 for single people or $500,000 for joint tax filers. This has implications if you're invested in a small business. Okay, let's say you invest in a business and you actually write off, you have business write-offs, things like that. In a small business, the tax code for like an LLC, let's say, the tax code right now allows you to essentially write off the first 20% of your income, because an LLC is pass-through income. It passes through the company and shows up on your personal tax return. Let's say your company earned $100,000 in income. Well, you earned $100,000 in income. Right now, you can essentially take the first 20% and throw it out the door. It's not taxable income. Now your taxable income starts at $80,000. So you wrote off $20,000. This rule wants to cap the amount you can write off to $400,000 for single people or $500,000 for joint. Now, of all of these proposals, the one that causes me the most heartburn is the increase in the corporate income tax rate. Because you're talking about basically increasing the corporate tax rate for all of the companies we invest in. And if you raise their taxes, what do you think is probably going to happen to their stock prices, at least in the short term, maybe intermediate term? It's going to drive the market crazy. The market's going to go down. There's no real surprise why we saw major economic and market growth when the corporate tax rate went from 35 to 21%, right? When companies don't have to pay as much in taxes, their earnings go up, and when their earnings go up, their stock prices tend to follow. If you're going to increase their taxes, their earnings are going to go down and their stock prices tend to follow, right? So I'm most concerned about the corporate tax rate going up. Long term, it probably wouldn't have that big of a deal, but at least in the short term, maybe a year or so, we would probably see the market react negatively if that were to happen. So what are your thoughts? Anybody have any thoughts about any of those proposals that concern you the most? Are there any questions that popped into your head? So Ralph asked a great question about, the difference between single or joint filers. Are there any of these proposals that we talked about today that have spurred questions? Or are you just sitting here thinking, man, they just find any way to separate me from my money, right? Which the answer is, yeah, they do. But here's the thing. One thing that is true is that when the tax code taketh away, it giveth in other areas. Your job, our job as advisors, is to use the tax code to our benefit. Try to find ways that we can benefit from it. There are always ways. Okay, there's always a way. But clearly they're trying to close some of these, I won't call them loopholes, they're actually honest to goodness strategies, but they're trying to close some of those, particularly for high income and high net worth households. So we are now just past 1 o'clock, so we've come to the end of our time today. I want to thank you very much for joining us on the Wednesday Lunchtime Drive Through today. I hope you had a great time. Make sure, tell your friends about us. Other people that would benefit from hearing some of this information, send them the link or email me at damon@chappelwood.com and say, hey, Damon, my friend Monica wants to join the webinar here. So send her the link so she can get registered. Or better yet, send me their information and I'll register them for them. Let's see, we do have a question here. Why not, Kevin asks, why not just accelerate the 2026 tax increases? It's not clear how these would affect those. Well, the major effect, Kevin, is that the 2026 tax increases are going to impact everybody. So all of the tax rates that were lowered are going to go back. So everybody is going to see an increase in their taxes. These proposals are looking to accelerate the tax increases right now for just the top income tax bracket. Okay, so everybody else would still be paying the lower tax rates through 2025. But this proposal wants to increase the top tax bracket from 36 to 39.6 or 37 to 39.6 a lot sooner than planned. So that's really the impact there. Everybody else, for the most part, at least according to this proposal, is going to be untouched. At least that's what the proposal looks like. They're truly targeting the top income earners and very wealthy families to pay for all of these things. I would not even expect this bill to end up like this. There are going to be even more changes. Tax legislation takes time, and there's a lot of haggling that goes on behind the scenes. I would be very surprised if this proposal is the actual one we see, but it's the latest that we have. And it is the clearest picture, like I said, of what we will most likely end up with. So thank you, Kevin, for that question. Oh, and hey, thanks for your connection to Wade Pfau. I appreciate that. I got his book. Came in the mail to me yesterday, so I'm going to start reading that. So thank you for your recommendation on that. So everybody else, thank you so much. I hope you have a great rest of your day. Thank you so much for being on the Wednesday Lunchtime Drive Through. Hope you have a great rest of your week. And thanks so much again. We'll see you next time. Bye-bye.